The stock market is soaring. Everyone's making money. Social media is full of people bragging about their gains. It feels unstoppable until suddenly it isn't. The headlines scream, markets crash. Your portfolio is bleeding red. Your savings look smaller by the hour. Panic sets in. And here's the question every investor faces. What do you do when markets tank? Because in that moment, emotion screams louder than logic. Fear tells you to sell. Anxiety tells you to hide. The instinct to protect yourself fights against the possibility of losing even more. But history is clear. The people who panic in downturns lock in their losses. The people who stay calm, who act with strategy, not fear, often come out stronger than before. This video isn't about theories. It's about survival. It's about the exact steps you can take when everything around you is falling apart. Because markets will crash. That's inevitable. What matters is whether you let the crash destroy your future or use it to build one. So let's dive into what to do with your money when markets tank. Meet Daniel. During the last crash, he watched his retirement account lose 30% of its value in just weeks. Every day he opened the app on his phone, hoping it had stopped. Every day the numbers looked worse. Finally, he snapped. "I can't lose everything," he told himself. With trembling hands, he sold every share, convinced he was saving what little remained. But here's what happened next. The market kept falling for a short while. And then it rebounded. Slowly at first, then sharply. Within 2 years, prices were back at record highs. Daniel thought he was escaping loss. Instead, he locked it in. His money never recovered because he wasn't invested when the rebound came. He sold at the bottom and sat on the sidelines while others rebuilt their wealth. This is the number one mistake people make when markets tank. Fear convinces you to sell at exactly the wrong time. And while it feels safe in the moment, it's actually the most expensive decision you'll ever make. Because history shows us something powerful. Markets crash, but they also recover. Always. The only people who lose everything are the ones who give up too soon. So if panic is the wrong move, what's the right one? Here's what most people forget in a crash. Markets are built to recover. Look back through history. The Great Depression in the 1930s. The dot-com bubble in the 2000s. The mortgage crisis in 2008. Each time, the market fell hard. Each time, it looked like the end. And each time, it eventually climbed higher than before. Why? Because markets aren't just numbers on a screen. They represent businesses, real companies creating products, hiring workers, solving problems, and driving innovation. Crashes wipe out the weak, but the strong survive and grow. And as long as people keep building, markets keep recovering. The problem is perspective. When you zoom in on a crash, all you see is pain. But when you zoom out, the crashes are bumps on a much larger upward road. That's why long-term investors win. They don't see a crash as the end of the game. They see it as part of the game. So the first rule when markets tank is simple. Don't panic. Stay invested. Understand that volatility isn't a sign of failure. It's the price of admission for long-term growth. Because the truth is, the only people who lose in every crash are the ones who quit. So if panic isn't the answer, what is? Step 1. Strengthen your safety net. When markets tank, uncertainty spreads. Jobs feel less secure, businesses tighten budgets, and fear ripples through the economy. That's why your first move isn't selling stocks, it's protecting your foundation. Check your emergency fund. Do you have at least 3 to 6 months of essential expenses saved in cash or a safe account? If not, focus on building it. This cushion gives you confidence when everything else feels shaky. Step 2. Review your budget. Crashes are the perfect time to cut waste. Cancel subscriptions you don't use. Delay big purchases that aren't urgent. Every dollar you free up adds strength to your safety net. Step 3. Stay liquid. Don't tie up every cent. Having accessible cash means you can handle surprises without touching your investments. And in some cases, it means you'll have dry powder ready for opportunities when others are forced to sell. Think of it like building storm protection. You don't abandon the house when the storm comes, you reinforce it. Because the real danger in a crash isn't just the market falling. It's being unprepared when it does. And once your foundation is solid, you can think about the next step, not just surviving the crash, but using it to grow. Here's the paradox of every market crash. While most people see disaster, the smartest investors see a sale. Think about it. When your favorite store runs a 50% discount, you don't panic, you rush to buy. But when stocks fall by the same amount, people run the other way. That's the difference between fear and opportunity. During the 2008 crisis, legendary investors were buying while everyone else was selling. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." It's not just a quote, it's a strategy. Crashes expose value. Strong companies with real profits get dragged down alongside the weak. If you have the courage and the cash, those moments become once-in-a-decade opportunities to build wealth. Of course, this doesn't mean gambling on every beaten-down stock. It means focusing on quality. Companies with strong fundamentals. Index funds that represent entire economies. Investments you believe will thrive over the next 10 or 20 years. Because when markets tank, prices drop, but value doesn't disappear. And those who understand this truth don't just survive downturns. They build fortunes from them. But let's be honest, buying during a crash feels impossible. When everyone around you is panicking, when the news is screaming collapse, when your account balance is bleeding red, the last thing you want to do is invest more. Fear takes over. This is psychology at work. Humans are wired to avoid pain, and seeing losses triggers the same part of the brain as physical danger. Your instinct says, "Get out, protect yourself." But following that instinct in investing usually means selling low and missing the rebound. The truth is, successful investors train themselves to act against the crowd. They know that fear creates opportunity. They remind themselves that downturns are temporary, but discipline is permanent. How do you build that discipline? Start with rules. Decide in advance what you'll do when markets fall. Maybe it's continuing your monthly contributions, no matter what. Maybe it's setting aside extra cash to invest when the market drops by a certain percentage. By having a plan, you remove emotion from the moment. Because if you wait until fear is everywhere, you'll never act. Discipline isn't about ignoring fear. It's about preparing so you can act despite it. That's the mindset difference between those who lose everything in crashes and those who quietly build wealth while others panic. So how do you actually protect yourself and grow through downturns? It comes down to strategy. First, think long-term. Market crashes feel endless in the moment, but history shows they're temporary. If your horizon is 10 or 20 years, a short-term drop is just noise on a bigger upward trend. Time is your greatest ally. Second, diversify. Don't bet your future on a single stock, a single sector, or even a single country. Spread your money across different industries, regions, and asset classes. When one area falls, another can balance it out. Diversification doesn't eliminate risk, but it makes risk survivable. Third, never go all in. Putting everything on one bet may look tempting, but it's gambling, not investing. Crashes punish gamblers. Smart investors keep reserves, stay balanced, and build steadily. And finally, keep investing consistently. Whether markets are rising or falling, regular contributions smooth out volatility through what's called dollar-cost averaging. Over time, this strategy outperforms panic-driven moves almost every time. These principles aren't flashy. They won't make you rich overnight. But they're the reason long-term investors sleep at night while short-term speculators lie awake in fear. Because the truth is, you don't beat crashes by avoiding them. You beat them by preparing for them. Let's compare two investors in the same crash. The first is Mark. He had no plan. When the headlines turned dark, he checked his portfolio every hour. Fear consumed him. Finally, he sold everything, thinking he was protecting himself. Months later, when the market recovered, Mark was still on the sidelines. His money never bounced back, because it wasn't invested to recover. The second is Sarah. She had a plan. She knew crashes were part of the journey. She didn't watch the market every day. She stuck to her long-term vision. She kept contributing, even when it felt painful. She reminded herself that quality companies don't disappear just because prices fall. A few years later, Sarah's portfolio was not only restored, it had grown beyond her pre-crash wealth. Mark, meanwhile, was still trying to figure out when to get back in, missing opportunity after opportunity. The difference between Mark and Sarah wasn't intelligence. It wasn't luck. It was mindset and discipline. Crashes test every investor. Some break under the weight of fear. Others bend, adapt, and come out stronger. And when the next downturn comes, because it will, you'll have the same choice. Will you be Mark or will you be Sarah? Here's the truth. Markets will crash again. Maybe next year. Maybe in 5 years. Maybe tomorrow. No one can predict the exact moment. Not experts, not economists, not algorithms. But you don't need to predict. You need to prepare. Because in every crash, wealth doesn't disappear. It transfers, from the impatient to the patient, from the fearful to the disciplined, from those who panic to those who stay the course. When markets tank, you have a choice. You can let fear dictate your actions, sell at the bottom, miss the recovery, and lock in regret. Or you can act with clarity, protect your foundation, keep investing, and use the downturn to build assets at a discount. It's not easy. Fear will scream louder than logic. But that's the test. And those who pass it don't just survive crashes, they use them as the launchpad for long-term wealth. So the next time the headlines turn red and chaos takes over, remember, this isn't the end. It's the opportunity. Because in the story of money, markets always recover. The only question is whether you'll still be invested when they do. Your move decides your future.